If you've ever wondered who really controls the global economy, the answer might surprise you. It's not governments, and it's not even individual billionaires acting alone. Two names stand above the rest: BlackRock and Vanguard. These asset management giants collectively control trillions of dollars in investments, and their fingerprints are on nearly every major corporation you can think of. From the tech devices in your pocket to the food on your table, the drugs in your medicine cabinet, and the media you consume daily. They are the largest shareholders in Apple, Microsoft, Amazon, Google, Coca-Cola, Pfizer, ExxonMobil, JP Morgan Chase, and thousands of other companies across every sector of the economy. To put it in perspective, BlackRock alone manages over $10 trillion in assets as of recent reports, making it the largest asset manager on the planet. Vanguard manages over $8 trillion. And here's the kicker: Vanguard is also one of the largest shareholders in BlackRock, and BlackRock owns significant shares in Vanguard's client funds. This creates a circular ownership structure that concentrates economic power in ways the world has never seen before. But how did two firms accumulate such staggering influence? And what does it mean for you, for markets, and for the future of capitalism itself? Let's dive in. Let's start with the basics. BlackRock was founded in 1988 by Larry Fink and a small group of partners who saw an opportunity in risk management and fixed income investing. Over the decades, the firm evolved into a behemoth by pioneering computer-driven investment strategies and acquiring competitors, including Barclays Global Investors in 2009, which brought with it the iShares family of exchange-traded funds, or ETFs, that now form the backbone of BlackRock's dominance. Vanguard, on the other hand, was founded earlier, in 1975, by John Bogle. He revolutionized investing by introducing the first index fund available to everyday investors, allowing ordinary people to passively invest in a diversified portfolio that tracked the entire stock market at a low cost. Bogle's vision was democratization, making wealth building accessible to the middle class. But ironically, Vanguard's scale and reach have now made it one of the most powerful entities in global finance. Both firms operate primarily as passive investors, meaning they don't actively pick stocks or try to beat the market. They simply buy shares in every company within a given index, such as the S&P 500, and hold them on behalf of millions of clients, including pension funds, retirement accounts, university endowments, and sovereign wealth funds. This passive model sounds benign, even boring, but the sheer volume of assets under management gives these firms unprecedented voting power at shareholder meetings, where critical decisions are made about executive compensation, mergers and acquisitions, environmental policies, labor practices, and corporate governance. When BlackRock and Vanguard together own 5, 10, or even 15% of a company's shares, their votes can swing outcomes. And because they are the top shareholders in competing firms within the same industry, say Coca-Cola and PepsiCo, or Pfizer and Moderna, they have the ability to shape entire sectors. Critics argue this creates a troubling dynamic. If the same two firms own large stakes in rival companies, what incentive do those companies have to compete aggressively on price, innovation, or quality? Some academic research suggests that common ownership by large institutional investors may reduce competition and lead to higher prices for consumers, though this remains a subject of debate among economists. What's not debatable is the concentration of power. According to data analyzed by financial researchers, BlackRock and Vanguard are among the top 3 shareholders in roughly 90% of S&P 500 companies, giving them a combined voice that echoes across boardrooms in New York, Silicon Valley, London, Tokyo, and beyond. And it's not just equities. They hold massive positions in bonds, real estate, commodities, and increasingly, alternative assets like private equity and infrastructure. This means their influence extends into governments as well, since they are major holders of sovereign debt. BlackRock, for instance, has been called upon by the Federal Reserve and the European Central Bank to manage emergency bond buying programs during financial crises, effectively making the firm a shadow arm of monetary policy. Larry Fink, BlackRock's CEO, has become one of the most influential voices in global finance. He publishes annual letters to CEOs that read like policy manifestos, urging companies to prioritize environmental, social, and governance criteria, commonly known as ESG, and warning that firms ignoring climate risk or social inequality will face consequences from investors. Some applaud this as responsible capitalism. Others see it as unelected corporate power dictating social policy. Vanguard, while more low-key in its public messaging, wields similar clout through its ownership stakes and proxy voting. Both firms insist they vote in the best interests of their clients. But the question remains, who decides what those interests are, and how transparent is that process? Proxy voting guidelines are published, but the day-to-day decisions, especially on contentious issues like executive pay, political spending, or labor rights, are made by relatively small teams within these firms. And there's limited accountability or public oversight. This brings us to a deeper, more controversial topic that's been circulating in online discourse and among certain political commentators. The idea that BlackRock and Vanguard are architects or enablers of something called the Great Reset. This phrase was popularized by the World Economic Forum and its founder Klaus Schwab, who in 2020 published a book by that title outlining a vision for rebuilding the global economy in the wake of the COVID-19 pandemic. The book and associated initiative called for rethinking capitalism, emphasizing stakeholder value over shareholder value, accelerating digital transformation, addressing climate change, and reducing inequality. Ambitious goals that, depending on your perspective, sound either like enlightened progress or like a technocratic power grab. One line from promotional materials associated with the Great Reset, "You will own nothing and be happy," has become a lightning rod, interpreted by critics as a dystopian vision where individuals are stripped of private property and forced into a rental economy controlled by corporations and global elites. Supporters of the World Economic Forum argue this phrase has been taken out of context, that it was meant as a speculative scenario about the sharing economy and digitalization, not a policy prescription. But the phrase has nonetheless fueled widespread suspicion, especially among those already skeptical of concentrated corporate and governmental power. So, where do BlackRock and Vanguard fit into this narrative? Both firms are closely tied to the World Economic Forum. Larry Fink is a frequent attendee at the annual Davos Summit, and BlackRock has been vocal about pushing ESG investing, which aligns with many Great Reset themes such as transitioning to renewable energy, promoting diversity and inclusion, and integrating climate risk into financial decision-making. Critics see this alignment as evidence of a coordinated agenda among global elites to reshape society from the top down, bypassing democratic processes and imposing a new economic order, where ownership is consolidated among a few powerful institutions, while individuals become perpetual renters or subscribers, whether it's renting homes instead of owning them, subscribing to software instead of buying it, or leasing cars instead of purchasing them outright. There's some basis for these concerns. Home ownership rates in the United States have declined among younger generations. Major investment firms have been buying up single-family homes in certain markets and converting them to rentals. And the subscription economy is indeed growing across many sectors. Whether this is driven by a deliberate agenda or simply by market forces and demographic shifts is hotly debated. But the fact that BlackRock and Vanguard have significant investments in real estate, technology platforms, and consumer goods companies means they do stand to benefit from these trends. It's also worth noting that both firms manage money on behalf of millions of ordinary people, your pension, your 401k, your IRA. So in a legal sense, they don't own these assets outright. They manage them as fiduciaries. However, the control they exercise through voting rights is very real. And the line between management and ownership can blur when you're talking about trillions of dollars in influence over corporate strategy. Another dimension to consider is the revolving door between these firms and government. Former BlackRock executives have held senior positions in the U.S. Treasury Department, the Federal Reserve, and other regulatory bodies. This raises questions about conflicts of interest and regulatory capture, where the rules meant to govern an industry are shaped by the very people who benefit from them. Some observers argue that BlackRock and Vanguard have become too big to fail in the same way major banks were during the 2008 financial crisis, and that their systemic importance gives them outsized political influence. On the flip side, defenders of these firms point out that passive index investing has been a boon for average investors, lowering fees, increasing market access, and delivering steady returns over time, and that the alternative, a fragmented landscape of smaller asset managers, might actually be less efficient and more prone to corruption or mismanagement. They also note that BlackRock and Vanguard compete with each other and with other large players like State Street, Fidelity, and foreign sovereign wealth funds. So it's not a pure duopoly, yet the numbers are hard to ignore. When two firms are the top shareholders in the vast majority of the world's largest companies, and when their CEOs have the ear of presidents, prime ministers, and central bankers, it's reasonable to ask whether this concentration of power is healthy for democracy and free markets. As we look to the future, several trends are worth watching. First, regulatory scrutiny is increasing. Lawmakers in the United States and Europe are beginning to ask tough questions about common ownership, proxy voting, and the role of asset managers in shaping corporate behavior. There have been calls for greater transparency, limits on voting power, or even structural reforms to break up these firms, or separate asset management from asset ownership. Second, the rise of ESG investing, which BlackRock and Vanguard have championed, is facing a backlash in some quarters. Critics argue it prioritizes political correctness over financial returns, and that it gives asset managers undue influence over social policy. Several U.S. states have even moved to divest public pension funds from firms deemed too focused on ESG. Third, technology and competition are evolving. New players, including crypto-native asset managers and decentralized finance platforms, are emerging as alternatives to traditional finance. And while they're still small compared to BlackRock and Vanguard, they represent a potential shift in how wealth is managed and invested. Fourth, public awareness is growing. More people are asking who owns the companies they buy from, who profits from their data, and who controls the systems that shape their lives. And that awareness is driving demand for accountability and reform. So what does all this mean for you? It means that the next time you buy an iPhone, fill up your gas tank, take a prescription drug, or stream a movie, there's a good chance that BlackRock and Vanguard are indirect beneficiaries of that transaction. Because they own shares in Apple, ExxonMobil, Pfizer, and Netflix, among thousands of others. It means that the investment choices made by a relatively small number of people in New York and Pennsylvania can ripple across the global economy, affecting jobs, prices, innovation, and even the political landscape. It means that the debate over the Great Reset, ownership, and the future of capitalism is not just theoretical, it's playing out right now in boardrooms, regulatory hearings, and investment portfolios around the world. And it means that staying informed, asking critical questions, and demanding transparency from both corporations and governments is more important than ever. This information is for educational purposes, and if you're making financial or investment decisions, it's always wise to consult with a qualified financial advisor who can tailor advice to your specific situation. And that's something worth remembering the next time you hear the names BlackRock and Vanguard. Because understanding who owns the world is the first step towards shaping the world you want to live in. What's your take? Are BlackRock and Vanguard too powerful, or are they just efficient market players? Drop your thoughts in the comments. And if this opened your eyes, hit that like button, subscribe, and turn on notifications, because we're diving deep into the systems that shape our world.